Carrier Connect Data Solutions is acquiring, consolidating, and operating Tier 2 and Tier 3 data centers and co-location facilities. CEO Mark Binns is here to outline the company's data center and co-location acquisition strategy and growth plans. It's Wednesday, April the 9th. I'm Martin Gagel with Market Radius Research. Please remember this is neither recommendation nor investment advice. We're here to learn about the company. Mark, great to have you here. Congrats on your newest venture. You went public less than 2 months ago, so I'm sure most people do not know your story yet. So it's good to have you here getting the word out.
Thanks, Martin. Great to be here. I'm excited to tell the story of Carrier Connect today and the new venture that I'm on. It's been a couple of years since I've been on your show. I really enjoy it, so I'm looking forward to being here today and answering some questions and giving some people some information. As you said, we just went public probably 6 weeks ago, 7 weeks ago. It's actually my first live webinar and first video on the story, so I'm excited. We're right at the start of the evolution of the company. So it's a great time for investors to see the story, learn about it, and make an investment decision, maybe to join us on the journey as we go. Carrier Connect Data Solutions, the ticker CCDS. As you see, we're on the venture. And with that, I'll walk through the deck here. Disclaimer, I would encourage everyone to read that in their own time. I'm going to start real simple. What's a data center? So that's a picture in the background of a data center. That one's obviously super full. Those are racks, basically up and down with little handles on them you can see and locks. And inside of those racks are computers and servers. And they're stacked up one on top of each other. And those servers run the internet. They run people's cloud-based software. They run AI. They contain data storage for people's solutions. And by people, I mean usually it's a company or a software company. It could just be someone's own business that they're running, and that's where they keep their servers and data storage. Really, a data center is a physical location that stores computing machines and related hardware to run them. Computing infrastructure, really for any sort of IT system or AI system. We'll talk a little bit about AI, and that's helping really drive demand for data centers. And we give our customers power to run the machines, cooling. They run very hot when you have a lot of them jammed in a small space. So you have to have cooling, fiber optic connectivity. So you have high speed connections coming and going from your servers so you can serve your customers on the internet. And any other networking equipment, cabling, et cetera, required to hook it all together. And again, it's really a physical facility storing a company's digital data or servers that are used for processing. What we don't do is we don't run the servers. Companies bring their own equipment and put them in a data center, and then they go back to their main office and they manage their servers remotely, and they use those to provide their solutions to their customers. We're not running their servers for them. We're providing them a home, a physical location to run them in a powered up, cooled, redundant way, hooked up to fiber optics, et cetera. And what's happening in the data center industry when this company was born out of a CPC, a capital pool company that I created. And I went looking for opportunities and said, what are we going to do? And data centers kept jumping up. I kept hearing about data centers. Our legal counsel was talking about data centers as being a real growth industry and a large revenue generating industry with excellent margins. And here's one chart. You can find 100 of these on the internet that all look the same from Precedence Research, showing basically the expected growth in data center market size or revenue, both in the US and globally, rising from 104 million back in 2023, about 10 years or 11 years to 2034, $360 billion. And the US market growing from 36 billion to 70 billion. Canada's in the global market, but we're a Canadian-based company. Our data centers are going to be located globally. We are looking at multiple opportunities in multiple countries, and that gives our customers disaster recovery and data redundancy and stuff if they have servers in more than one location. So it's a good part of our strategy to have multiple data centers in different jurisdictions anyway. But that's one chart on the growth. I go back here, sort of just written a different way, right? 2023, 114, 2024 growing to 125, going out to 364. Compound annual growth rate over 11% a year. And that's the big full pie. It is growing that fast. Of course, we believe With our strategy and acquisitions that we're going to make, we'll be able to grow much, much faster than, the general market growth, but it's great to be in a growing market. And the largest market is really North America, where we're centered right now. Our first data center that was part of our go public transaction is at 200 Burrard. It's right downtown in Vancouver. It's our flagship data center, heart of Vancouver. It's hooked up to the fiber optic core and ring in Vancouver, connecting to the rest of the country and the rest of the world. It is right beside Harbor Center, which is actually where all the fiber for Vancouver and British Columbia all terminates and originates in and out of Harbor Center. So we have multiple diverse paths because we're sitting right next door to that on purpose for high-speed internet connectivity. We have 50 racks of space. And again, I mentioned these are racks in this picture up and down, each one with the computers in between it as a rack. All provisioned and ready to go. There's capacity to expand in our existing footprint. We have redundant power. So the way power works in a data center is you get power from the grid or wherever you're getting power from. It's essentially BC Hydro in BC. But then you have battery backup systems or UPSs sitting there in case there's any glitches with the power connectivity, the building were to lose power, flashes or outages. Battery kicks in and keeps running all your servers. That's a big part of what you're looking for in a data center, is that your machines are always running. And then behind those battery backups, you have a generator. They call it a genset. And it's like a large diesel powered generator that can run for days. And it is behind the battery system and makes sure power never goes down. So if something, drastic happens in the power grid in Vancouver, which hasn't happened probably in 50 years, but you're always ready for multi-day outages, and all these servers keep running for our customers, and they stay cool because the cooling systems keep running, etc. We also have 24-hour manned security, easy loading facilities to get access in and out. We're right down in Metro Vancouver. And this company was part of, again, the go public transaction. We did 360,000 in revenue in 2024. So when we started, we didn't start with an idea to build a data center. We started by buying an existing data center, existing revenue stream, existing customers. And there's lots of space in the data center to expand. We're looking at 500,000 as the target for this year. But this is the first, and we'll talk more about the bigger strategy. This is just the first data center, the one that got us going. The opportunities are very significant in the space, and I'll jump into that in a couple of seconds about the go forward strategy. But why would someone pick us? We talked about tier 2, tier 3. Tier 1 is the top of the heap. You walk into a tier 1 data center and they'll put you in this big plastic bubble that'll shoot air all over you and sniff for like bomb residue. Like, the amount of security can become extremely sophisticated. In a data center that's more of a tier 2, tier 3, you go in, there may be, biometric login, could be a handprint, could be an eye print, could be something like that, a key card, front desk security, that sort of stuff. It's all just levels of essentially security, levels of redundancy for power. And after that, you're competing on price. So where we're sitting in the market against, just a couple of other companies in the space, which are excellent companies, by the way, Cologix, eStructures, there's many around. We'll have more value pricing because we don't have some of the stuff that they have in our data centers on purpose and by design to hit a mid-tier of the market. And a lot of companies do not need the kind of security that they have, for example. They don't have data that's that, which shouldn't say important, but that critical. Anyway, so we can win on value pricing, and we can win on, service. We have people that can, go into the data center, help you, hold your hand, all that sort of stuff. And as you get into the bigger ones, maybe you don't need that kind of personal service. So that's a bit about the space. I think more importantly is the timeline of success here, where we're going. So 2019, Carrier was incorporated. That's the private company that runs the data center at 200 Burrard before we met them. In 2022, they actually acquired the data center. 2024, they achieved their 360,000 in revenue, and they signed a definitive agreement to go public with my CPC. And we merged together and we listed as Carrier Connect Data Solutions, which is the public company, CCDS, with one wholly owned subsidiary, which is the data center asset at 200 Burrard. As I said, that's the start of the strategy. What we're going to do is acquire a second, third, fourth data center data centers and build a portfolio. Roll these up, basically be able to smooth the costs of being a public company, having CEOs, CFOs, regulatory stuff across multiple revenue streams, multiple data centers, and that can create a very efficient company and a very high value company. As you scale in size, the multiples that you'll get based on the revenue will increase. What we're looking for is assets or data centers that are not core to who owns them right now. So they're willing to part with them and they're willing to part with them for a good price. But they would be core to us. One example might be a software company that, has a whole bunch of different products and services and they have a data center, but that's not core to their delivery of their services. They could just rent space in anyone's data center. And we can go in and buy it from them, add it to our portfolio, and then we can offer customers, again, servers in multiple different locations for disaster recovery, for example, increasing our share of their wallet in the space. There's also entrepreneurs that own data centers, whether it's, two guys, a small company, and they have leases on them. And at the end of the lease, the landlord says you have to return the entire space back to original office space, which can be very costly and very expensive. And those owners have no liquidity in their business because it's a private company other than the cash that it generates on a monthly basis. So we can say to them, listen, we can give you liquidity. We can buy you for stock in our company. And you don't have to worry about returning the data center back to its original form and that large liability that's overhanging you because we're going to extend the lease with the landlord. We're going to add this to our portfolio and we're going to run it indefinitely into the future. So that's attractive to those kind of entrepreneurs and small businesses that set up data centers as this market has been emerging. So the plan is get a few of those, grow the revenue stream, grow the asset base, and then we'll look to do something bigger. So, maybe it'll be a JV or a greenfield operation where we build our own data center or partner with an existing much larger data center company and do a 50 or $100 million build out of something that is in the 5, 10, 20 megawatt type of size, which is a very large sort of hyperscaling, as they might call it, data center. And that might take us into 2027. So we'll see. First, build a portfolio by acquisition, by M&A, and then we're going to look to continue to grow, and that could be through greenfield build outs or JVs with other partners. I want to talk about Perth, Australia. So this is the first data center that we have an LOI in place to acquire and add to the portfolio. We're in conversations with data centers all across Canada, multiple cities in Canada, in the US, more in Australia. We're going to have a lot of different conversations going, and then we'll pick the right ones and where the opportunities are right and the prices are right. This is a 2 megawatt facility. To compare, the one in Vancouver is about a quarter of a megawatt facility. It's in the 8 times bigger range, 220 racks of space. It depends how you design the data center and lay it out, but it's getting to be a pretty good size. It has 3 large diesel generators, 3 industrial chillers, and chillers are what basically cool water and then run them through the data center through these inline coolers that between all the servers keep everything cold. Full battery backup systems. We believe it has a $330,000 a month revenue potential in its existing footprint with its existing hardware. In our news release, we talked about the equipment that's there. To build a 2 megawatt facility today would cost $20 million if you just went out and build one. The ranges are between 7 and 12 million a megawatt. So, it is a round number, $20 million to build it. All the equipment that's already in it is worth, we think, between 6 and 8 million dollars. We have a deal to buy it for 2.5 million Australian with $300,000 upfront payment and the rest on a vendor take back. And this is obviously tremendously accretive to our shareholders and to our business for the price versus the opportunity. And it all comes back to what is a core business to someone and what is not. And to us, this is a very core asset and a perfect addition to a growing portfolio. To the company that we're buying it from, it's not a main part of their business. And they're happy to remove it essentially from their portfolio by selling it to us. Just quickly on people, I mean, at this stage, we're a $5 million market cap. You're going to invest in this company based on the team, I would say first and foremost, the sector, the vision, the plan, and of course, eventually the execution. My whole background has been in public markets. I've been a CEO of a public company on the CSE, the TSX Venture, for 6 years directly as a CEO of big digital assets. That started at two people, just like basically we are now. We're a very small team of 4 or 5 people at Carrier, two people and an idea, and grew that to $1 billion market cap at one point in April of 2021. Built a very successful business, multiple lines of business, multiple companies under that public portfolio. I've raised a lot of money. I have amazing relationships in the Canadian capital markets and the US capital markets, both with investment bankers, the brokerage community, the high net worth community, the fund community, and I'm ready to take all of that experience and knowledge that I built over all those years and bring it to bear on Carrier. And the exciting part is, starting as a sub 5 million, now $5 million company, the opportunity and the upside from here is tremendous as a multiple from $5 million. My business partner is a guy named John Arnett. John actually bought the data center originally and started Carrier Connect. He's grown 9 different IT companies. He won BDC Young Entrepreneur of the Year award at one point. He also does advice in the IT space to investment banks on investments. And it was his data center at 200 Burrard that we put together with my shell. And now we're partners in building this together. John knows more about IT, and he's forgotten more about IT than I'll ever know. I have an IT background, but he's definitely the brains on the IT side of our partnership. And I'm really excited to be working with John to expand this business. And his relationships are the ones that brought us the opportunity in Australia that I just talked about. We have 2 board members, Mitch Demeter. The name's probably pretty familiar to anyone who's invested in the Canadian capital markets. He ran Netcoins from a small organization to one of Canada's leading crypto exchanges, and it was Canada's first government-regulated crypto exchange that was a public company. He sat on the board of Big. He currently sits on the board of Bitcoin Well and Neptune Digital Assets. He understands the digital space. Perfect fit for us. We've worked together a lot in the past, so we have a good relationship, which just really helps things move smoothly and quickly. And then we have Peter, who is basically a Canadian entrepreneur. He's also Vancouver-based. He'd be well known as a director of Victory Square Technologies, an accelerator in town. A lot of people would know Peter through Victory Square. Also a director of Spark RE Technologies, Copilot, TTGI, which is Turnium Technologies, Rentity Technologies. Peter is an experienced public markets director and a perfect guy to help us along the way. Almost to the end, cap table. This is probably the part that I'm most excited about, along with the business, is we have a really, really tight structure. We came in, we bought a data center with 2 shareholders. Everybody that was in the CPC is people that are known and trusted and close to us. I built it myself. We didn't buy a shell from someone else. It was my own. So we only have 11.27 million shares or 11.269 million shares outstanding, about 1 million stock options, a tiny number of warrants from our original IPO of the CPC, fully diluted 12.3 million shares. 36% of these shares are owned by insiders. More than 4 million shares are owned by insiders that have this as a 3 to 5 year vision. That's my plan. Is this the next 3 to 5 years of my life, building this company out? 50% of the shares are escrowed 24 to 36 months out, so 5.6 million. And another 1.7 million roughly are on a 4-month hold, but there's only 4 million shares free trading. It's a tiny amount of free float. It's a great opportunity again at this market cap. This company with a very tight structure. It's not bloated. There's no cheap paper going to come out and hold us back as we grow and build our business and raise the stock price. Catalyst, I think it's the last slide before the thank you. We're going to get a second data center. So it's funny, as I built this deck the day we went public, or a couple of days before we went public, and we already have a second one lined up in Australia, as we talked about. Double top line revenue. I think we're going to actually do much more than that very quickly here with an additional data center. We're going to get a US listing, get DTC eligibility, get on the QB. I've got a lot of good relationships in the US, and with Chris King at the OTC Markets Group as an example. We'll get that done, and then we can unlock, direct investment in the stock, but also people that will want to buy financings as we grow and acquire more assets out of the US. Upgrade 200 Burrard. It's the first data center. We can continue to add potential and capabilities there to unlock higher revenue. And then investor outreach. So tell the carrier story. This is what investors want to see is someone is going to get out there, tell a story, pound the pavement, let people know about it. This is, like I said, the very first sort of public foray into that since we went public here with you, Martin, which is great. And we're going to be doing a lot more of this now and letting people know about what we have, what we're doing, and where we're going to increase interest and investment in carrier for the benefit of all of our stakeholders and shareholders. And with that, we'll wrap it up from a presentation point of view, and we'll go over to questions and have a conversation about carrier. So thanks, Martin.
All right. That was good, Mark. Thank you. I was as you were saying that the data center model kind of reminds me a little bit like the self-storage real estate model. You have a unit, you don't go in there a lot, you go in there once in a while to fix something or drop something off, you clip a rent, and it's just a steady business, and a lot of people have made a ton of money off of the self-storage business
You're absolutely right. It is incredibly similar. We're like self-storage for company servers
for
and the same
data.
model,
Yeah.
right? We provide them the storage facility. We don't go tinkering with their servers, just like, people don't go into your self-storage bin and look at what you put in there, right? They come in, our customers come in, they every once in a while will check their own servers in person, change things, rewire things, add servers, whatever. The rest of it they manage remotely. And we're just providing the box, the space, right? So I've talked to contacts at RBC and BMO and different places already. If we say we need a large line of credit to do acquisitions backed against the assets, they said, yeah, that fits in our self-storage group, essentially. Like they immediately, bankers understand that this is what this business is.
Interesting. Okay.
And the stickiness of the customer base is incredible. I think we have customers that go back like 15 years in our data center in Vancouver before we owned it, before John owned it, because IT guys put their gear in, they put their servers in. They don't ever want to take them out. They don't want to touch them or move them because that means there could be risk or
Yeah.
downtime. So as long as we're providing the space and the power's there and the cooling's there and the fiber's working, they never leave. So way better than software when they talk about churn and software as a service multiples. In the data center space, your customers are incredibly sticky and yeah, great for business. And if you read the margins, the EBITDA margins on typical data centers and public data centers that you can go look up are running at like 40% EBITDA. And that just churns month over month and year over year.
I presume you're on the smaller data center side, so is it fair to assume your customers would be the small to medium sized businesses? You're not going to be running a data center for RBC or
Yeah,
uh,
that's
or
correct.
TELUS or anything like that.
100%. So we are, at the smaller end of the market today. As I said, we plan to amalgamate multiple data centers and then offer multiple locations, which will let us move up in the sort of the customer pecking order. And then when we build something, much larger, that's where our customers could literally become Amazon AWS. So Amazon is a cloud provider, and a cloud provider just means they offer servers to other people for rent. Those servers have to go somewhere, and they go in data centers. And there's AWS servers in bigger data centers in Vancouver. And those guys can become our customers. You can move all the way up to the RBCs, and then even above them, it's the providers like the AWSs and the Microsoft. That they need a lot of space. They need a lot of servers. So you need bigger data centers. And that's part of our growth strategy. Acquire a number of smaller to medium size, tier two, tier three, and then eventually move up to tier one facilities. So, but there is a huge market for mid-sized companies and mid-tier companies that don't want to put their gear in the cloud. So they don't want their servers with Amazon because Amazon obviously makes money. So they realize that yeah, there could be some conveniences, but there's very significant costs to moving their servers into the cloud and letting Amazon own them and just rent them back. So they decide, you know what, we're going to run our own. You know where those go? They go in our data center. Someone shows up, they buy 2 racks and they put in 25 servers and we're good to go.
I didn't realize I assumed all of Amazon servers were in Amazon buildings. I didn't realize they dropped servers into third party data
Yeah,
centers
they're
to
in
fill?
third-party data centers all over the place, and they
Okay.
would have started entirely in third-party data centers. And then as they're growing so fast, they start building some of their own custom data centers or hyperscaling facilities.
Yeah.
But they need the amount of processing power and servers in our world is growing so fast, they can't build their own facilities fast enough. So they have to use other people's data centers. And new data centers that are being built right now, we know from friendly other companies in the business, they're being leased out 6 and 12 months in advance before they even open their doors.
Yeah.
And they are being leased to people like Facebook or Microsoft or Amazon, et cetera. So absolutely, they need the space.
And I guess the prime driver is obviously the price, and then the capacity utilization. You want to get to 100% filled in there because there's virtually no cost to they use some power and data and so forth, but you just want to fill the whole place up. How is the capacity utilization at your current facility and what you're moving, hopefully going to, or I presume to be acquiring down in Australia?
Yeah. So we're probably around half full at our current facility in Vancouver, maybe a little
Okay.
over that. And you're right. So utilization is the big driver of profit because once you put in all the cooling, all the electrical systems, the generator that can run the whole facility, for example, you want to amortize that over those costs over as much revenue as possible. But the fixed costs are there and you can be break even or profitable in most of these facilities at like a quarter full. And after that, it's all just profit. And that's where you can get to those 40% EBITDA numbers and higher. And the variable cost being, you nailed it, the power that you add every time you add some more machines. But it's very profitable to add those machines. So that is the play for us is to fill up these facilities. Lots of growth room in the one in Australia as well. I won't talk specifics because we're still under LOI. But the upside potential and what we have is significant, and we'll be making money right away anyway. But it's just become more profitable as we fill them up. And I would buy a data center based on its assets and its potential revenue stream, its space, its power. Um, Whether it was a 10% full or 100% full. You'd pay a different price for it with the revenue streams that come with it, but both are valuable to us because we can fill them up.
Well, I would think you get a better discount on a less full one where you have to do you got to put in the work to fill it up, and if you know how to do that through your network and marketing and so forth, then you can really create a lot more value than sort of acquiring a fully optimized, 100% loaded existing data center.
Yeah, that's right. And that's what we've mainly been looking at. I mean, most of the ones we look at have significant upside potential and room and space. And then you can spread, and this is where you win by having multiple, is you have one director of sales that we will be hiring who will sell space in all the data centers. It doesn't matter where they are physically, they can sell the space across all the different data centers and fill them up. That's what the other, national and international players do is they have teams centralized, putting customers into all the data centers and often into more than one at the same time, as I mentioned earlier, for things like redundancy. I mean, if a giant earthquake hits Vancouver and the whole city goes down, but if you have a data center also in Australia and you have your servers there, your customers will never even know the difference because you'll be able to keep serving them from the other servers. So that's why they have centralized sales teams that will sell you into multiple data centers at the same time as well.
Can you comment on about the current acquisition? When do you roughly expect that should be closed?
I think we have give or take 45 days under exclusive due diligence period, et cetera. So 2 months at the outside is the goal. I think, our goal is much shorter than that, but that's sort of the time we have under our LOI. We don't see any reasons why we can't do it within that time frame currently.
All right. And what sort of cadence to acquisitions do you think you could pull off? Like one every couple of months, or like what does your backlog or pipeline of potential M&A look like, and how quickly could those potentially sort of fall in the hopper?
Yeah, good question. I mean, we have 6 or 7 active conversations going on right now. We got to be careful not to try to close too many simultaneously, just from a capacity point of view, due diligence point of view, legal point of view, all that sort of stuff. But I could see us doing one a quarter, potentially slightly quicker. We probably won't be closing three in a quarter, but there's not like you need to be 6 months apart or anything. So, my rough answer is, one a quarter or slightly better would be our goal at this point.
And are there general acquisition metrics on it, on a multiple of EBITDA or on square footage or of mega or kilowatt sort of power access? How do they sort of like what are the typical metrics?
Yeah, I mean, a lot of them are based on revenue, and you can find EBITDA multiples on revenue. The power is another big driver of the value of the data center because, again, there's a lot of data that shows how much it costs to build per megawatt, et cetera. But we're going to be trying to acquire outside of the typical multiples. And that's, again, where we find assets that are um, non-core to the owner, and they want to get rid of them out of their portfolio because they are distracting to them, or they aren't generating revenue for them the way the rest of their business does, or there's a regulatory reason, or there's a small group ownership reason where they lack any sort of liquidity, right? So as we know, being in the public markets, that a company with all other things being equal, the same amount of revenue as a public company is usually much more valuable than the private company because there's liquidity for shareholders and people will buy it and own it based on the liquidity. So we can come into some of these private ownership groups and offer them liquidity by buying them for stock and bringing them into the Carrier Connect story, which frankly, gives our shareholders many times the return of the value of the asset that we pay for with our stock. So, you pay $1 million in shares, but it's worth $5 million asset or a revenue stream. Everybody wins, especially the entrepreneur who, again, had no liquidity and no way to cash any of that out for his retirement or whatever the case might be. So we'll be looking for assets where we can acquire them basically cheaper and on a better value for our shareholders than the typical multiples.
This seems like a business that would be ideally structured on the cap table once you get bigger to have a decent debt portion on it as it's sort of steady business and clear like assets and clients and so forth. Can you talk about at what point you maybe I guess talk about your whole capital market strategy, doing acquisitions, you're going to have to raise some equity, probably more relative equity at the beginning. Then when you get bigger, you can layer on more debt as you've got a bigger base of operations. Talk about that.
Yeah, you're absolutely right. This business lends itself extremely well to using debt for acquisitions and using debt that's backed by the assets of the data center that we're buying. So we can have, whether it's facilities with large lenders that will let us go and look at opportunities to buy something, and it might be $20 million. But if the asset is worth $25 million or $30 million, the lender will happily, lend us the money secured by the asset and then pay it back to them with a coupon rate, 8, 10, 12%, whatever it ends up being over X amount of years. And everybody's happy. That's their business. They do that. That is the way the self-storage business works, as we talked about earlier. Same idea, right? There's people that go out and have rolled up lots of these very successfully using that model. So we intend to use that model as well. And in fact, if you look at the LOI on the Perth acquisition, it has a vendor take-back note for a large percentage of the actual acquisition cost, which is exactly that. It's using debt to buy the asset. In this case, the lender is the former owner of the asset, but it could just as easily be, RBC. So that'll be a part of the business model. We want to dilute, frankly, as little as possible. A big part of, again, having an 11.2 million share equity float is coming out really tight and trying to stay tight. We're only going to raise money really as required for soft costs, things like, legal and M&A costs, and travel costs to go see these places. And to some degree, there'll be operating costs, but we should be able to use debt for any large acquisitions dollar-wise, and we should be able to just raise small amounts of capital along the way, which, again, will allow us to show tremendous return on the stock is the idea. And everybody wins again, because again, the people that are selling to us, they can get some equity, but the value of it to our shareholders should be much higher than the equity we're giving out. And we use debt where we can, and off we go.
Would you use stock as part of your acquisitions as well if the partners are interested?
Yeah, I could see a blend, right? It can be
Yeah.
some stock, some debt, some cash. Again, cash is king though. We'd rather not pay in cash. And where it's in stock, again, I think the return is higher than the cost of the stock to shareholders. So I think it'll be a mix, and I think it'll be deal dependent, depending on what the seller is actually looking for. And we'll just have to make an evaluation on a case by case basis.
Right. You just closed in a financing as well. The cap table you showed, did that include that financing in there? And just like, are there warrant? Oh, I guess there are no warrants because there's so few on there. Just what were the terms on that financing?
Yeah, it was a very small financing. It was only $250,000, 1.7 million shares. It was basically to cover startup costs and RTO costs from the merger of the shell with the data center. So very minimal, very non-dilutive. I could have taken $1 million easily at that point. Had to turn away more people than we accepted, but we just wanted to do a very small financing of 250,000, and that's already included in this number of 11.269 million. And those shares are on a 4-month hold, probably 3 months left on it at this point right now, so they're not even in the market.
Yeah. We definitely have to talk about you mentioned AI already. The big hyperscalers are doing a lot of the AI, but then you've got like their open source models where you can run, I think it's Llama on your own servers, and then out of China they have the DeepSeek where you can actually
Yeah.
run models off of relatively small data centers and servers with pretty powerful results. How is the AI revolution affecting it? It's just generally ramming up the demand for data centers, and that's just pushing up demand, or are there any specific dynamics or certain data center you need extra cooling in a AI data center, any aspects like that that are relevant?
Yeah, I mean the biggest top line headline, I guess you'd say, is that AI is driving demand for data centers. And the reason it's driving demand for data centers is that AI queries are much more capital intensive on servers than a typical Google query. So I usually tell people, people used to Google, I'm going to Dublin or Ireland, and what should I do? And then Google would spit back some answers, right? Some links and the usual stuff. Now they go to ChatGPT and they say, design a holiday for me and my teenage kids in Dublin for 1 week in April. And, it'll spit back a whole itinerary and a whole vacation and recommendations around hotels. But that comes at a processing cost. So numbers I've seen say that AI queries take 10 times as much processing power as a Google query, 10 times as much processing power in very, very simple terms is 10 times as many servers, right? So if you have so many queries would fill up one server that would go in a rack in a data center, the same amount of queries to AI would take 10 servers in a rack in a data center. So uh, just think about the global demand for space in data centers because there's more and more and more servers being used because there's more and more AI queries. Businesses are moving to AI, entrepreneurs are moving to AI. Everybody's looking at it one way or another to see how it can help their business. And that's what's driving, the adoption of AI is very similar to the adoption of and the demand for data centers. And, if it's hyperscalers, it's a big, big, big AI companies, they're putting their servers into tier one facilities. Well, guess what? They're full. And then people that would have maybe put their stuff in that facility but can't get access but need space in Vancouver, well, they're going to go and put it in a tier two facility. There's a trickle down effect through all the levels of data centers, and especially because they're literally full, tons of them. You got to go to where there is availability. So, and it doesn't matter if it's DeepSeek or ChatGPT, more AI companies in general will require more servers to serve their customers, which requires more data centers to basically host all those servers.
All right. Mark, that was good. I can't think of any other questions to ask. Anything we didn't cover you want to highlight before we wrap it up?
No, I think that was excellent. My contact information, if you can still see it, I'm not sure is on the screen. Market Carrier Connect DS for like datasolutions.com. Feel free to reach out. This deck is available on our website at carrierconnectds.com. And yeah, we're excited about where we're going. We're at the start of a process. Again, it's $5 million market cap. We're dedicated to a multi-year play here, and we expect to deliver a lot of results. So yeah, I welcome everybody to join the team, become shareholders, and be part of the journey. And thanks for your time today, Martin.
All right, Mark, thank you. That was great. Great overview on the company and the industry. Have a great day, and I'd love to get you back here when you get the growth going more and see how things progressing. Thank you very
That
much.
would be great. Okay, thanks, Martin.
Cheers.